Swayam Prabha. Digital India. Educated India.
Welcome, dear learners, to the another session of International Business Management. Today we are going to begin with International Financial Management Issues, and this lecture is divided in two parts, Part 1 and Part 2. I, Dr. Manisha Goswami, Assistant Professor of Institute of Business Management, GLE University, Mathura. Let's look at what we did in our previous lecture. In our previous lecture, we talk about certain forex derivatives like swap, future, forward, options, and we also try to see how these different future forex derivatives can be make use of in order to deal in foreign exchange market. And we also get to know that how you can minimize the risk, what different management skills you need to make use of in order to identify how you are going to minimize the risk of foreign exchange regulatory bodies. Explain the types of the capital flow. We discussed the foreign investment theory and the barriers to it. What are the barriers while you are putting forward your money in the international market? What are the different theory, like particularly the purchasing power parity theory was discussed in the previous lecture. We also try to find out the different payment methods of international trade. And during that discussion, we get to know there are certain methods of payment which seems to be more favorable from the point of view of importer, and there are certain payment which seems to be more favorable from the point of view of the exporter. Say for example, in case of a consignment is considered to be one of the safest mode for the importer, because in case of a consignment, importer don't have to make the payment until and unless the goods which he has brought from the exporter are sold off in the market where he want to sold off, and then only he is going to release the fund to the exporter. Where in case of a cash in advance, it seems to be the most best option of the payment, because in this case exporter would be getting the advance before the shipment of the consignment to the importer. So this is just an overview of what we did in our previous lecture. Now we are heading towards today's lecture, that in this particular lecture we will try to find out what are the international financial management issues, right? And the various learning points of this lecture have been classified into various different points, and the flow charts are presented in front of you. Let's look into it and try to see what we have to do and what are the things which we have already done. So today we will be talking about some of the factors related to the nature of international financial management. We will also discuss the domestic and international financial management, and we try to compare it with the domestic financial management in order to understand that how the international financial management is different from the domestic financial management. We will also try to cover the environment of international finance. However, we had talked about the political risk management already. We had covered the currency derivatives. We had talked about the foreign exchange. We have covered the currency convertibility. So these are the things already covered in the previous lecture, but in this lecture we will be focusing on international financial market. We will be focusing on the balance of payment, and we will also be focusing on the international monetary system. The scope of international financial management, like the different decisions, or we can say the functions of financial management, will be covered in the next part of this lecture. So let's begin with the nature of international financial management. As far as the scope of finance is concerned and why there is a need of a finance, that goes without saying that if you are into some sort of transaction, then you need a currency in your hand. It is not a barter system where the commodities are going to be exchanged, as now we are in the era where exchange of goods and services are taking place through the currency, through the proper transaction of the currency, and it is an agreement which people sign before taking a call that in what will be the rate of your currency, at what time the particular product will be delivered, what is going to be the price of the currency at that mode. The people are taking a fair decision and taking a fair understanding before they are calling for the transacting the deal between the buyers and the sellers. You just take an example of the future contract. In future contract, what buyers and sellers do, they try to fix the rate well in advance. They try to fix the date also well in advance. So that is, they are getting into buying and selling of the currency, but at a particular price and at a particular rate and at a particular time, right? So that kind of the dealing is taking place, and that kind of the agreement is coming up in between the buyers and sellers and about the goods and services. But money is the main motive, or money is the thing which is going to facilitate that kind of transaction, or money is going to be the thing which is going to make your transaction to go on smoothly. But there is a concern that when you are having a transaction within your country, there is no issue of conversion. But when you are dealing with some foreign country, there is a need of a converting of your currency into some universally accepted currency like US dollar, pound, euro, yen. Then you have to bear certain convertibility charges, and those convertibility charges are going to be determined on the basis of the economic condition of your country. So let's get into know and what finance is, what are the different types of finance, and how your decisions are going to vary based on the different types of the finance that you are having. So now look at the finance is classified into two broad areas. One is the public finance, second is the private finance. As far as the public finance is concerned, it is going to be the revenue which government generate, right? So public finance is a finance which government is regulating, right? Government is having the control over the public finance. One is the revenue, second is the expenditure, third is the budget, fourth is deficit and surplus, and fifth is debt. So these are the different types of a public finance. Say for example, when we talk about the revenue, how government would be collecting the revenue. Government is going to collect the revenue through imposing tax upon us. A tax can be of like sales tax, it can be like income tax, right? Or else it can be the tax related to the property also, the estate tax and the property tax. So these are the different tax which government is imposing upon the citizen of a country, and that's how they are generating the revenue. And what the government is going to do on the basis of this collection of the revenue, what government would be doing it? Government is going to make use of this fund which they have collected through the tax imposing tax upon the citizen. They are going to make use of this money for the expenditure. And now what kind of expenditure they would be doing? They would be doing the development of the infrastructure based on the expenditure. That is the thing which is going to be the part of the expenditure of the government, because if they are getting the money, they are going to expand it on developing the infrastructure of a country. Now how infrastructure of a country can grow? It can grow on the basis of improving the health science of a country, education system of a country, right? They will be spending on it. They will be improving the transportation of a country. They will be improving the network system, that is the data sciences. They will be trying to improve to have fair connectivity between the Indian companies and the foreign companies, right? So they are even equally going to improve the electricity supply, the power supply in a country. So this is going to be the part of the expenditure. These are the area where the government want to expand their money in order to improve the infrastructure. Why they want to improve the structure? Because foreign companies won't come to your country if you don't have a smooth basic infrastructure in your country. So for making foreign companies a lucrative market to enter into, government has to find out how to raise the fund from the market, or how they are going to generate the revenue from the market. These are different taxation policies which government will be imposing upon the citizen, and citizen will be paying to the government, and government, after the collection of the money, is going to make the budget, that in what different area I will be putting the money. So after revenue generation, they will be preparing their budget, and they will be presenting their budget in the parliament, and after this they are going to start the expenditure. Budget will be made for the health improvement, for the education improvement, transportation improvement, network data science improvement, information system improvement, electricity is going to improve. So altogetherly they are focusing on the area of improving the infrastructure of a country to make it an attractive country in the world market. Next, there is a prime concern of the government also to find out the deficits and the supply. They may be the possible, the percentage of the revenue which they have generated is quite less than the expenditure they are making in the market. So how they will be meeting out the gap if the revenues are very less as compared to the expenditure? This was a scenario before the complete transparency in the system, before the demonetization and GST. There was a system that people used to hide their earnings. They don't used to present the true facts to the government, and that's why lot many people were income tax payer, but they were not paying taxes. If you are the payer of 70 lakhs of the taxes, but you are just paying 30 lakhs of taxes, that means the people try to hide the facts and figure from the government. But just after the GST system incorporation and because of demonetization, things become quite clear, and lot many people start now paying taxes to the government. So somehow government try to overcome this problem of the deficit. Deficit means that your expenditures are more than the revenue which you are generating in the country. So government try to find out the measures that where the gaps are, and they come up with the very right policy of the GST. They come up with the correct demonetization action in the market to overcome this problem of excess of the expenditure, and they find the ways of generating the revenue from the citizen itself. Those who were trying to hide from they were trying to hide the facts, true facts from the government, and they are not letting they are not making correct payments, and they are not liable towards the government by paying the correct taxes to the government. So government find the measure and they try to overcome this problem of the deficit. Surplus is the situation where your revenues are so much, then your revenues are high than your expenditure. So this situation is not here in our country, but in most of the developed nation, this is a fact that the revenue generation is quite high as compared to their expenditure of the country. And most of the time, in order to overcome the deficit situation, apart from structuring the internal country taxation policy, apart from this, government also go for taking the loan from the financial institutions. They also take borrowing from financial institutions like US Treasury is there, like IMF, World Bank is there. The government of a country used to borrow certain amount of money from these financial institutions in order to overcome the issue of the deficits. Right. So this is about the public finance. The other side is the private finance. Private finance is the finance which the people are earning. That means the businessmen of our country are earning is going to come under the private finance. Right. There is no intervention of the government. It's a sole proprietary business, or it's a partnership business, or it's a company. That means you are having a stake over your business. When it comes to a sole proprietary, what situation you have to face? You have to face the losses and profits alone. There is no risk sharing here. Because why there is no risk sharing? Because you are the sole proprietor. You are the whole soul of your company. You are the whole soul of your organization, that with the limited liabilities, right? So whatever the loss you are earning, it's your loss. Whatever the profit you are earning, it's your profit. But in case of a partnership, you are going to share their risk. Risk sharing is possible. So if the loss is there, it's a loss of both the partners or the three partners, whatever the number of partners are there in your corporation. And if there is a profit, all are going to share the profits. As far as the company finance is concerned, this is the finance which the company are going to make use in order to development and the growth of the entire company, and helping in generating the employability as well as the improving the infrastructure of a country. Apart from this business finance type, there is a finance for non-profit organization, that companies have to invest in CSR activities for supporting the downtrodden class of society, right? So that finance has to be taken out from the entire portion of your revenue. You have to take out the 2% of your of the entire percentage of revenue. You have to take out 2% for investment in the CSR activity. Apart from this, there is some portion of the personal finance. You must be drawing your own salary. You might be a owner, but you must be having your own salary account there in the organization of yours. So you must be drawing certain salary, and that salary is purely your salary, which you can spend upon meeting out your own livelihood, or you can spend for insurance, for getting your better retirement plans or your pension plans. That is purely your money, and you are paying taxes for the money which you are earning as per the income tax norms and regulation. So, after understanding the scope of finance, I think you must have a broad classification that there are two types of finance, that one is the public finance, another one is the private finance. Public finance is actually generated by the government, and government is framing different policies in order to regulate the flow of public finance for the development of infrastructure of a country itself. On the other side is a private finance. These are the different businessmen or the private owners of a company where there is no government intervention. They have a full right over the earnings of the organization, but they have to pay taxes as per the taxation laws of the government. So there are three different types of the private finance, like the business finance is there, non-profit organization finance for the non-profit organization, that is your CSR activities should be rendered, and personal finance. Now we are heading towards the different phases of the finance function. Now, what are the different phases of finance function? That means there are four different stages. First stage is talking about decide which asset I need to purchase, yani finance function, how I am going to make use of the finance. So first you are going to question yourself that what are the different assets that I need to buy, what are the different things I need to have in my organization for the better production. So I need to find out whether I need to improve the premise, I need to improve the infrastructure of my factory or my business outlet, or I need to improve the machinery or further equipments I need to buy. So first you have to find out where you have to make the investment. Do I need to make the investment in improving the premise of my factory or my manufacturing or my plant layout or the process layout, where I need the improvement? So you are going to question it. If you are going to get to know that there are certain machinery which you are making use is quite outdated, because of which a lot of errors are coming, right, defect is generating, and unnecessary the cost of production is increasing. So you will be trying to find out the solution to it. Let us stop making use of this machinery and let us buy some machinery. And if you are taking a call of buying a machinery, then another question arises in your mind, that from where to buy this machinery. Is I'm going to buy the Indian machinery, locally assembled machinery, or I should go for importing a machinery from China or from Japan or Korea, which particular place I will be importing? Then that kind of the analysis is going to come under the stage 1. Stage 1 is finding out in which particular asset you are going to invest the money, where the money to be invested. Second stage is talking about that determining what is the total investment. Okay, fine, you decided that I need to buy a machinery in the stage 1, and you decided that I'm going to buy a machinery from Korea. That is the stage 1. Stage is over, and you have evaluated what is the amount that I have to make the payment for getting that machinery from Korea. So determining what is the total investment I have to make, since asset cost money required for buying the asset and the fixed capital requirement, you have to figure out that this much amount of money I needed for buying the machinery from South Korea. And then the third stage is going to talk about your working capital management, because it's not just about the fixed capital which you require for getting the machinery, or it's not just the fixed capital which you require for running the entire organization. You need to meet out certain day-to-day expenses also. So to determine how much cash he would need to run the daily operation, payments for the raw material, machinery, wages, working capital management has to be understood well in advance. Because if you are taking a call of buying a machinery, suppose from South Korea, and you are importing this machinery to India, so you need some mechanic, you need some engineer to let the worker know that how this particular machinery is going to work. There should be some proper training should go on, and who will be paying that amount of the trainer for giving you the required training? That is going to be the part of the working capital management. And what about those days, during the days of the training there will be no production in your organization, so how you are going to bear that loss of no production in the organization because training is going on? So that is going to be the part of your working capital management. Then after this, the next stage comes, that is decide what all sources does the entrepreneur need to tap the finance, the total investment, assets and the working capital. That means your fixed capital requirement and working capital requirement are there. You have a fair idea that these many crores of money I need for buying the machinery and for managing my work during the absence of the production, because my workers will be trained to cope up with the new machinery. So you have a fair idea now that this much amount of this much crores of the money I need. Then you are going to question yourself that either I should go for debt money or I should go for equity. These are the borrowed fund. Debt funds are the borrowed fund. That means you are borrowing the money from the banks or some financial institution, or private investors or angel investors are there. They might be investing in your bank and your idea. On the other side is a equity. When you issue initial public offering in the market, then you can own the fund. You can get the fund, and such kind of the equity fund generation is known as the own fund. That means you don't have to pay any interest upon it, whereas in case of the debt fund you have to pay the interest, and there is a timeline, right, a specified timeline at regular interval, after which you have to make the payment, and finally you have to repay all the entire amount. There is a stipulated time being given to you. But in case of equity, it is not the case, right? You are generating the fund through IPOs, you are generating the fund through the shares in the market, but you, in later stages, once you start earning profit, you might have to share the dividends, you might have to share some profits with your shareholder, but initially that's not a liability upon you. But there is a issue of sharing your ownership. If you are okay with sharing your ownership, go for equity fund. If you are not okay with sharing your ownership, then go for the debt fund. In case of equity, you are sharing the some portion of your stake of your organization to the various stakeholders. So if you are ready to share your ownership of your organization with the stakeholders, with the shareholders, then go for equity. Otherwise you should go for the debt fund. I hope these phases of finance functions are also clear. Now we are heading towards the aim of finance function. Now, as far as the basic aim of finance function is concerned, it is about acquiring sufficient fund. Why finance functions are used, what is the basic purpose and utility of it, is to find out that how much fund I need, maybe the fixed fund or the working capital fund, that how I am going to acquire that sufficient fund. Acquiring of sufficient fund is the main prime concern and a main function of the finance area. And once you have acquired the fund, maybe through the debt fund or the equity, whatever the measure you have used, and you have acquired the fund, then you need to work on finding out how you are going to make use of this fund properly, right? There has to have a proper gap analysis. Otherwise, whatever the fund you have raised from the market might get wasted. So you have to keep on analyzing that, are we making a correct investment? Are we taking a correct investment decision? Our financial decisions are correct or not? Liquidity decisions are correct or not? That's all togetherly are going to help you to understand that we are making a proper utilization of fund or not. Next step is increasing the profitability. That goes without saying that when you are doing a business, you are not doing a business for charity, you are doing a business for earning the profit, and more to the profit maximization. Your focus is on wealth maximization. So whatever the money you have raised and wherever you have invested, the ultimate purpose back in the mind is profit maximization, undoubtedly. So if the profit maximization is your sole motive and the prime motive, then you also have to see that whatever the investment decisions you are making, investment decisions should lead to return on investments. That means how quickly I'll be able to get the returns on the investment, and for this there should be proper calculation of time value of money, there should be proper calculation of payback period, right? That capital budgeting has to be done well in advance. With that capital budgeting is going to help the firm to find out what is going to be the rate of return, and by when I will be start getting the returns, or by when I'll be able to reach to the break even point or start enjoying the economy of scale in the market. That has to be identified well in advance. And next is the maximizing firm value, which that again, this is now another point of concern. Earlier the organization used to confine themselves to the profit maximization only. There was no such a stage like a wealth maximization, but now organizations are moving to the next level, that is towards the wealth maximization. That means their initial purpose is not just profit maximization, because profit maximization is usually considered as a short-term gain. But if you want to survive in a market for longer span, but if you want to sustain your business for longer span, your sole objective should not be profit maximization. Rather, your sole objective should be the wealth maximization, or maximizing the firm's value. The larger the firm's value, there will be the possibility that firm will be earning the profit for sure. If firm value are higher, that goes without saying, the profit will also be higher. So they started focusing on maximizing their wealth rather than focusing on the profits. Now let's look at the major objectives, or the prime objective of any organization, that is profit maximization or the wealth maximization. Let's try to look into the difference between the profit maximization and the wealth maximization. So the objective of the wealth maximization is the large amount of the profit. They are, no matter how hard my workers are suffering, no matter my customers are satisfied or happy with this, as I'm enjoying the monopoly, I'm having a sole ownership. So I will be focusing on what? Maximum profit maximization. I will be trying to create a havoc situation for the workers to work in. No matter how hard they are suffering, I want to get the work done by hook or crook. That is the profit focus orientation of the organization used to be earlier. And as far as the advantage of profit maximization approach is concerned, it is quite easy to calculate. That's very true, that you can quickly see this is this much of profit you earned in the previous financial year, and this is the profit which you are earning in this current financial year, and you can compare and you can calculate that are we progressing or are we going down. Easy to determine the link between financial decisions and the profit. So whatever the decisions of the investment I took in the financial year, earlier financial year and the current financial year, I can quickly assess out that whatever the decision I took in the previous financial year and the current financial year, which one is more appropriate, because in the last year I was gaining more of profit. As I can calculate it more quickly, I can compare and find out in the last financial year my profits were more, and the current financial year the profits are comparatively less. So I think I have made some incorrect investment decisions. So you can easily figure out and you can connect the link between your financial decisions and the profit. On the disadvantage side of the profit maximization, it emphasizes on the short-term gains. That goes without saying that if you are totally focusing on the profit maximization, you are ruining a lot of resources of your organization. So if you want to make maximum out of your resources, your focus should not only on profit maximization, rather than building the healthy relationship, or rather than having a wealthy environment in your organization by encouraging the worker, by making your customer happy. For sure you are going to be in the market for longer span of the time, and the profit that you will be earning is going to be for longer span. It is not going to be for shorter span. So profit maximization motive or adopting companies usually have a short-term goals. They don't have a long-term goal. Ignore risk or uncertainty and ignore the timings of the return here. They require immediate resources. They require immediate resources in order to get the immediate and quick results in terms of the profit maximization. On the contrary side, nowadays the mostly followed and appreciated by the corporate people, that they started focusing on the wealth maximization than solely on profit maximization. What they believe in, that if we will start focusing on wealth, profit will automatically come. So they started focusing on this prime area, which eventually will bring profits to the threshold of the organization. The highest market value of the shares, if the highest market value of my share is there, that means the people are liking my company, they are ready to invest in my company, and if they are ready to invest, eventually the fund will start circulating to your organization. Advantages is emphasize the long-term gain. It recognize the risk and uncertainty, recognize the timing of the returns, consider the shareholder returns. So whatever the disadvantage of the profit maximizations were there are going to be the part of the profit, this wealth maximization advantageous part. On the other side, there is a little difficulty in having or setting the link between financial decisions and the profit, because it is not so quick and immediate, and over the night you cannot make the calculation of the wealth maximization. So for the proper calculation of the wealth maximization, you have to give some time to your organization to grow and nurture and establish the roots in the market, and then later after 5 or 6 years you will be able to find out that whatever the wealth maximization strategies which you have framed for the organization proved fruitful to your organization or not. Can lead to management anxiety and frustration, because it's not an overnight activity. Like in case of the profit maximization, as it is a short-term gain, and you can quickly look for immediate resources to allocate and to get the profits from the market, but this is not the case in the wealth maximization. It is not so easy and it is not so quick. Today you put the result and tomorrow you are going to get the answer of it, or tomorrow you are going to get the benefit out of it. It is not the so most of the time it leads to the management anxiety and frustration, because they fail to understand that are we moving on a track or not, or we have been deviated. That is one of the disadvantages. So at this point of the time, people should keep a pace, people should be determined and firm and focused towards their wealth maximization rather than getting deviated. Now let's talk about the overview of the financial management. Let's see how the entire flow of the financial management goes, right? What are the main essential key areas involved in the financial management? So first prime concern of the financial management is the share value maximization. They believe that through maximization of share value, profits will automatically come in the organization. And for this maximization of share value, there has to have the correct financial decisions are going to come from financing decisions, are going to come from investment decisions, and the next is a dividend decision or the liquidity decision. And each and every decision is having a risk and a return. For this, you need to have a trade-off and you need to strike the balance between risk and the return. You need to find out which particular things have to be compromised for the sake of the betterment of the organization. That means here the concept of opportunity cost is going to play a significant role. When you're deciding the trade-off, the opportunity cost principle is going to take the place, is going to play a significant role in order to make you understand where to emphasize more, which particular thing to be initiated and which particular thing to be sacrificed for the betterment of the organization and ultimately for the maximization of the share value of the organization. Now let's look at the organization structure of the finance function. So in any organization, there's going to be the one main person, that is Chief Financial Officer, CFO of the organization. Obviously below the Chief Executive Officer, he would be working, right? And there is going to be a treasurer and the controller of the organization. So treasurer and controller. The treasurer job is very proactive. However, the job of controller is reactive. His job is proactive and his job is reactive. They are the people who are generating fund for the organization. They are the people who are finding the creditors for the organization. They are the people who are finding investors for the organization through their effective PR, public relationship. On the contrary side, the controller are the people who are working what has been done in the past financial year. They are the people who are keeping the record. They are the people who are maintaining the record for the better understanding and application and proper auditing, internal as well as external, so that proper taxation and the other liabilities can be meted out. So, however, the job of the treasurer and the controller is coming under the CFO, but treasurers are considered to be most credit worthy as compared to the controller, and the profile of the treasurer are highly paid as compared to the controller. So the different activities where the treasurer would be at the different posts under the treasurer is going to be the cash manager, credit manager, capital budgeting manager, fundraising manager, and the portfolio manager. They are the people who will be trying to build the portfolio of the organization in terms of their assets value. On the other side, the controller is going to take care of the financial accounting manager, the cost accounting manager, tax and data processing manager for effective internal auditing. And the internal auditing is equally very important. If the results of the internal auditing will not match with the external auditing, then there will be a raid in your organization. So their job is also very effective. But as far as the organization growth and sustainability and raising of fund is concerned, the treasurers are highly paid as compared to the controller. Controller job is on the past event, what had already been done. On that basis, they are evaluating and they are preparing a chart and preparing the balance sheets and the ledgers of the organization for effective internal auditing, and that they ensure that internal auditing should match with the external auditing. Now let's try to look at the difference between international finance and the domestic finance. International finance is coming from the foreign country, right? So the exposure of the foreign exchange, the currency impact this transaction, because every country is having their own currency and every currency is having their own market value, right? Say for example, today $1 is equals to 74.08 INR. Then this value may appreciate tomorrow or may depreciate tomorrow. So that is going to affect your business trading. So today if I fix that, I being the exporter, I am very happy and I fix the deal with you at the rate 74.08 rupees of a dollar, right? So what I am going to do, I am going to fix the rate because I am having a certain apprehensions that tomorrow the the price of the dollar is going to go down because of certain crisis or the economic fluctuations taking place therein. So there are certain fluctuations will be, so there may be the possibility $1 would be equal to maybe just 73.99 INR. So there is going to be the downfall in the value of the dollar against the Indian currency. So I as exporter will lose the money. So I am going to fix the money today. So such kind of currency impact is there in the transaction. However, there is no such currency impact when you are having a domestic business. Macro business environment, exposure to different economic and political environment, for sure you will get to know the different economies of the country, because the economic condition of a country are going to determine the currency rate in the market, because most of the countries valuation are going to be governed on the basis of the market forces. Now what are the market forces? Market forces are demand and supply. So as there is a lot of demand of the currency like US dollar, pound, euro, yen, mostly demanded in the market, so the valuation of these currencies are appreciating. So economic and political environment has to have a fair understanding. You, when you are dealing with international market, when you are having international financial issues, right, then you have to have a fair understanding of economic political environment to overcome those financial issues or the crisis. Exposure to the same economic environment, that means your domestic environment. You are just confined to your domestic. Here you have to look into all the host country economic political environment, because these two environment are largely going to regulate the value of the currency. Legal taxation requirement is another thing which is going to make it very difficult to invest in a particular country. Like exposure to different tax law and regulation is also one of the very important aspect which is going to impact the currency convertibility charges. If a country is having heavy taxation and regulation duties for the currency convertibility, then there will be a lot of money involved for converting your home country currency into the host country currency. Exposure to the same tax law and regulation, then there is no need of any such convertibility. Stakeholder group, stakeholder with different culture, belief and language is going to impact your international finance, right? Domestic finance, the stakeholder with similar culture, belief and language, so the level of the risk goes down, because you are comparatively aware of your domestic company, so you can find out which particular area I should invest in. Where in this case, as that culture is different, beliefs are different, the level of the risk of investment goes up, because you are just presuming and predicting how this particular host market is going to behave. So when you are taking an investment decision based on your analysis of the host country culture, their values, their belief and tradition, the risk level is comparatively high as compared to the domestic company. Foreign exchange derivatives also play the market, and the major players who influence the price are the forex dealers, or you can say the reporting dealers or interbanks. These are the people who influence the foreign exchange derivatives or the flow of or the price, and they are rather the market makers, right? Knowledge of forward you should have a fair knowledge of the future option, you should have a fair knowledge of the swap. In the previous lecture we had talked about that how forward and future behaves. When it comes to hedging, forward and future behave similarly in terms of its obligation, but the way they are trading is different. Say for example, forward is going to be traded through over the counter, however future is going to be traded through foreign exchange stock market, right? And there is a swap. So you need to have a fair understanding of all these foreign exchange derivatives, and we had a lecture about it in the previous discussion. We had talked about these foreign exchange derivatives, and the involved risk and the management of the risk have already been covered in the previous lecture. Knowledge of the forward future option is not at all required as far as the domestic finance is concerned. Standards of operating like book of account need to be maintained as per the GAAP and IAS. Now what is this GAAP is? What is this GAAP? GAAP is, if let us try to understand the full form of it, GAAP is actually a generally accepted accounting principle, and another one is the IAS. IAS stands for International Accounting Standard. International Accounting Standard, and there is another which is IFRS, which stands for International Financial Reporting Standard. IFRS is actually including both GAAP and IAS. That is, GAAP plus IAS is making IFRS. So as far as this international finance accounting system is concerned, your book of account need to be maintained as per the norms and regulations that by the generally accepted accounting principle and international accounting principle in order to adhere with IFRS. Right, so there are certain global accounting system which you need to adhere when you are into international market. However, in case of the domestic finance, there is no such need of having an understanding of what are the different foreign accounting system. So as far as international finance is concerned, there are various accounting options. So you need to take care and you need to have a fair knowledge. You should have some CA and OC of different countries and the legal advisors of different country to make you understand how you are actually going to make possible. Capital management, ample options of financing create challenges in its selection, whereas limited options available, hence not so much of challenges are there. So capital management is also going to be a little tedious, and the flow of the capital, there are various options in the international financial market. However, it is not so in the domestic finance. So the comparatively less challenges there. Now let's quickly look at the overview of the international financial market. As we had already discussed, that international financial market is going to talk about the forex exchange, it's going to talk about the forex derivatives, it's going to talk about the foreign exchange risk and the management, right, and what kind of the different exposure the company get when they move to the foreign market. Like in case of the forex foreign exchange risk, like transaction risk is there, translation risk is there, there is a risk of economy also, right. So let's have a little overview and let's see how all these things become possible in the international market. That foreign exchange market is a place where money denomination in one currency is brought and sold with the money denomination in the another currency. That how international finance market is working, that I am taking some currency, you are taking some currency. That means I am buying certain currency from you for the goods which I am selling it to you. So for instance, US firm import goods for the British company and US dollar need to be converted into the sterling pound. Like if in case we being Indian, we are selling certain commodity to America, then we need to send the goods to them and they need to give us US dollar, because US dollar is very readily acceptable to us. So they don't have to convert the US dollar into Indian rupees, because we also need some foreign currency for maintaining the foreign reservoir in our country and for maintaining the economy of a country. And if other situation is reverse, then if America is sending some commodity to us, then they will be asking us to convert the Indian currency into US dollar, then only the transaction will be completed. So this is what the foreign exchange, this is where the foreign exchange market take place. This conversion of currency from one currency to another is a typical transaction that take place in the foreign exchange market. Even when you are moving from your home country to the host country for the tourism purpose or for the medical tourism purpose, you will be converting your home currency into the host country currency. Say for example, for some dental treatment, you are moving to Australia, and then you have to convert your Indian country currency into the Australian dollar, right? So this kind of the transaction or the convertibility of the currency which is taking place will be coming under the international financial market domain. Now let's talk about how this international financial market or is actually able to function. So there are certain monetary system internationally which actually facilitate such kind of transaction to take place smoothly. So let's look into those international monetary system which are actually facilitating the global market to become a integrated economy. International monetary system mobilize the money across country, determine the exchange rate. The system encourage the government of respective country to manage the balance of trade and by reducing the trade deficit. So if in case you have some sort of the deficits, what you will need, you need some money to borrow from IMF, or you need some money to borrow from the World Bank or US Treasuries, right? So these borrowing is going to help a particular country government to overcome the deficit. So if you are borrowing certain money from foreign country, then again that transaction is taking place, that these IMF are sending money to India, and if they are sending money to India, that means you are getting money through foreign exchange, right? And if foreign exchange is happening, then international monetary system will come into picture, and they are the people who are setting the rules and regulation to get such kind of foreign exchange possible. IMS is well regulated system that make whole process of international trading smooth. International monetary system is a set of internationally agreed route, conventions, supporting institution that facilitate international trade, cross-border investment. Generally, the reallocation of capital between states that have different currencies also become possible. The currency system is managed float rather than the pure clean float. In our country, we are having a market forces and RBI control. We are having a managed float of the currency system. That means we are some portion of a country currency is going to be regulated through the demand and supply, and major portion is going to be taken care by the Central Bank of India. Central Bank, for maintaining certain range of the currency in a country, they keep on buying and selling the currency in the forex market, and because of that they able to maintain the valuation of the currency in India, which is going to facilitate more of export, less of import. The features of IMS now is going to be pretty clear and self-explanatory, as we had discussed about international monetary system in quite depth. That is, exchange rate arrangement is there, international payment transfer relating to current international transaction will become possible, international capital movement and international reserves are going to be created with the help of international monetary system, as it is a complete system of rules and regulation and the conventions which are agreed upon by the different countries in the world. Now, as IMS is trying to talk about maintaining certain situation in the balance of trade and the balance of payment, it is equally important to understand that how a particular country is trying to get the transaction done and how it is affecting the balance of trade of a country, right? Balance of trade can have three different stages, like deficit stage, surplus stage or the equilibrium stage. So, if you want to balance your trade, you need to see whether you are moving toward the deficit side or you are moving toward the surplus side or you are moving toward the equilibrium. Equilibrium is considered to be an ideal situation which is rarely possible and practically little impossible, but country try to move towards the equilibrium state. It is a difference between the money value of export and import of the material good. It is called visible items and merchandise. That means in the balance of trade, only goods are going to be considered. Services will not be considered under the balance of trade. Example of visible items like clothes, shoes, machine, etc. Clearly, the two transactions determine the balance of trade are export and import of the goods. Export and import of the services, like when you are exporting your goods and commodity to the foreign market, is going to come under the export, and whatever you are receiving from the foreign market is going to come under the import. So, the difference between the value of export and import is called the balance of trade or trade balance. So, whatever the gap is coming, if your exports and imports are different, then whatever the gap, whatever the difference is there, is going to be known as balance of trade. So, export minus import is going to give you the balance of trade. If the value comes out to be in the minus, then it will be termed as a deficit. As you can see in the next slide, the balance of trade may be surplus, or it can be deficit, or it can be equilibrium. So, if you are trying to find out the difference between export and import, and value comes out to be positive, balance of trade, then it is the situation of surplus. Other side, if the value is coming out to be the negative balance of trade, then the situation is of deficit. That means your imports are more than your exports, and whenever imports are going to be more over the export, that means your foreign reserves are going out. Whatever the foreign currency your country was holding is going out for buying certain commodity from outside. That is the reason why the current government has come up with Make in India concept, so that maximum of the production should take place within the territory of the country. So, whatever we used to import from outside, why don't we produce in our country itself? And once we start producing those commodity in our country itself, it is going to facilitate it more of export and is going to control over the import. And just in a previous slide, I told you that our country follow the managed float, managed currency, That means it is based on demand and supply market forces, but at the same time the central bank of a country, RBI, also take into stances and see what is the value of the currency, what is the percentage of the float of the money taking place in the country, and how they are going to regulate the flow of the currency by buying and selling of the foreign currency in the foreign exchange market in order to maintain certain range, is also the reason why they want to facilitate more of export and discourage the idea of importing the commodity from outside. Let's read this paragraph. The balance of trade may be surplus or deficit. I hope the concept is clear now. If value of export of visible item is more than the value of import of the visible item, balance of trade is said to be positive, favorable, and is also known as the surplus. In the next paragraph, in case the value of export is less than the value of import, the balance of trade is said to be negative, adverse, unfavorable, and the balance of trade is known as deficit. Here the values is coming in negative form. In case of the export is equal to import, right, this is an ideal situation. Export is equal to import, then this is known as equilibrium. Even though the country had a deficit in its balance of trade, this might offset by item or other account, especially by capital account. They try to offset, they try to overcome its negativity by some of the capital account. Balance of trade mercantile provides substantial account of payment emerging from international transaction, but does not reflect a complete picture of all the payments due to the country and the payment due to the country. Payment due to the country and payment due from the country. It's not giving a true picture, right? So you don't have a fair idea whether the payment is due to the country or the payment is coming from the country, and the true picture comes from balance of payment. So balance of trade is just one side of the coin. It is just focusing on the goods, right, where in case balance of payment is not only talking about the goods, it's equally talking about the services. So it is going to give you the complete and true picture, and also let you know that whether the payment is coming to the country or payment is going from the country. It is the difference between the national total payment. Now we started with the balance of payment, which is the more broader concept as compared to the balance of trade. Like balance of payment is broader, wherein the balance of trade is a part of it. So it is a difference between the nation's total payment to foreign country and its total receipt from them. In other words, it is a systematic record of a country receipt and the payment in the international economic transaction in a specific period of time. Since BOP take into account the different exchange of both visible and invisible items, tangible items, visible, that means the tangible items like your goods, here in this case invisible item like intangible items like your services. Both are going to get included here in the balance of payment. As both are the part of the balance of payment, it is going to give you the fair picture, the true picture. Therefore, it represents the wider and better picture of international transaction than the balance of trade, and it can be used for predicting the economy of a country. Each transaction is entered on the credit and debit side of the balance sheet. Main items of the credit side of the balance sheet is going to be the export of the goods, export of the services, unrecuted receipts. Now what unrecuted receipts are? These are going to include gifts, remittance, and even indemnities are going to be the part of unrecuted receipts, and the capital receipts are also going to be the part of the credit side of the balance of payment. And the debit side of the balance of payment is going to consider the import of goods and services and unrecuted payments. Here unrecuted receipts are there, capital receipts are there. When it comes to your debit side, unrecuted payment and capital payment are going to be, in the previous case the export of goods was there in the credit side, here in the debit side import of goods and import of services are going to be. So clearly the balance of payment is an application of double entry books keeping system, with the result that debit and credit will always match. So it is a bookkeeping system where debit and credit side both should be balanced at the end. In other words, the balance of payment will always be in the equilibrium. As we have just seen in the case of the balance of trade, there are three different stages: surplus, deficit, equilibrium. But in case of the balance of payment, it is always going to be in the equilibrium. The debit and the credit side both has to be balanced out. Just have a look at the sheet of the balance of payment, how it is going to be on the credit side, and this is on the debit side. So in the credit side, exports and imports, here the export, on the debit side import, unilateral transfers are taking, that is on the credit side, unilateral transfer, that means you are making payments, here you are receiving, capital receipts are there, and the capital payment, and all together is going to be balanced. So both are in the equilibrium state. Now let's see the difference between balance of trade and the balance of payment. Balance of trade is a record of merchandise only. It is just about the goods, and the balance of payment is about both goods and services. So it is dealing only with the goods, it is dealing with both goods and services. It does not record transaction of capital nature. However, the balance of payment is going to record the transaction of capital nature. So it is going to be a true indicator of the economy of a country. It is a part of the current account of balance of payment. However, this is not just the current account. It includes the balance of trade, balance of service, balance of unilateral transfer, balance of capital transaction. It may be favorable, unfavorable, equilibrium. However, the balance of payment will always be in equilibrium. Defect of balance of trade can be met out through balance of payment. However, in the case of balance of payment, it cannot be met. Whatever the defect is coming the balance of payment, it cannot be met through balance of trade. However, whatever the defect is coming in the balance of trade can be easily met through balance of payment. It is not the true indicator of economic relations and the economic prosperity of the country. However, the balance of payment is the true indicator of economic condition and the prosperity of the country. So this is what we had discussed about the balance of trade and the balance of payment, and how countries have to keep a watch over the movements of the balance of trade in order to ensure the effective economic contribution of the particular transactions which are taking place in a country for the upliftment of the entire nation economy as well as the world economy. Now let's look at what are the different topics that we had discussed today. Today we talked about the nature of international finance. Here under the nature of international finance, we get to know the different types of finance, like we talk about the public finance here and the private finance over here. And what are the different roles played by the public finance, what are the role played by the private finance, we get a fair idea of it. As far as the public finance is concerned, government is predominantly focusing on generating the revenue, and on the basis of that revenue they are trying to set the budget for the improvement of the infrastructure of a country, and the budget is further going to be used for the various expenditure. Budget is going to give you the blueprint how you are going to expand how you are going to spend the entire money for the upliftment or the growth of the nation as a whole, to make it a lucrative place for the foreign investors to invest in. Later we talk about the domestic and international, the difference between domestic and international financial management, and we get to know there are certain things which need to be taken into consideration when you are into international financial management, like you need to have a fair idea about the forex derivatives, right? You should have an idea of the currency movements, you should have an idea of the currency convertibility, where in case of the domestic market these things are not so required. Right, and we even talk about some of the environmental factors which were not covered earlier in the international finance. We talk about the international finance market, we talk about the balance of payment and its relation, and how good it is for understanding and analyzing the economy of the country, how it is giving the true picture of economy to the analyst, that we try to get to know through the understanding of the concept of balance of payment. Even we discuss the balance of trade, the different 3 stages of the balance of trade was also taken into consideration, and we also get to know about the international monetary system, how these monetary systems are facilitating the international financial transaction, how capital is moving from one country to another, how such transaction is facilitated, who is setting the norms, who is setting the convention. We get to know through this international monetary system. And in the next lecture we will be discussing about the scope of international financial management, like investment, financing and liquidity will be covered in the part 2 of this lecture. For discussing and delivering this lecture, I refer to these books, and thank you so much. I hope today's lecture is clear to all of you. Thank you so much.
Hello and welcome to this piece of literary snippet. We usually know William Shakespeare as the most revered figure in the history of English literature. But we often tend to forget that he has also been one of the most hated figures in literature. And here I'm not talking only about those boys and girls who have to memorize long sections from Macbeth or King Lear or Julius Caesar before they can go and sit for their school or college exams. But I'm also talking about people who are themselves quite famous authors. Tolstoy, for instance, considered the writings of Shakespeare to be, and I quote, crude, immoral, vulgar, and senseless. George Bernard Shaw absolutely loathed Shakespeare, as he did Homer. But perhaps no other criticism about Shakespeare is more damaging than the one which says that Shakespeare is a marvelous storyteller, provided someone has told him the story earlier. Now, this piece of criticism is particularly damaging because it is true. None of Shakespeare's plays contain any original story whatsoever. They are all written using pre-existing materials, pre-existing stories. Now, does that diminish the stature of Shakespeare as a dramatist? Well, I'll leave that for you to decide. See you in the next episode of Literary Snippets.